you said this idea that equity markets have systematically failed to provide accessible capital to the broad swath of American enterprise, forcing a mass exodus towards private debt markets. Like, that is just a huge change.
Nobody wants to have a balance sheet. No one wants to have assets. Everyone wants to be as asset light as possible. Private credit has happily stepped into that because they have sort of this asset capture model where, you know, heads I win, tails you lose. There's almost no one really willing to provide equity and a ton of people that are mandated to provide debt. And that's very distortive to how economies grow and develop.
Nothing said on Forward Guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, everybody. Welcome back to another Roundup edition of Forward Guidance. And we're back in action, back remote after a busy week at DAS. And we got the gang back together, but we've also got a special guest for the first half hour of this episode. So we're going to be doing a little bit of an interview roundtable format here. So super excited to have Hunter Hopcroft on with us, who we just found, or at least I just found out that he is a regular listener, which I'm beyond honored about because, yeah, you have some very fascinating takes on things. I would love, just feel free to introduce yourself, what you do, what you focus on, and maybe we can go from there.
Sure. So I started my career in the alternative asset space for a variety of RIAs and family offices, and then decided to pivot more to writing for a variety of reasons. And so I've worked for asset managers in research and thought leadership, and now I work for a fintech company involved in private markets and sort of leverage lending in the 401k space, which maybe we can get into. So have moved from sort of participant to observer. And about, I guess, 3 or 4 years ago, I started writing really regularly on Substack, kind of a sweeping thesis about financialization of markets and really financialization of the economy, which has led to a few placements and longer form pieces, which tends to lead to conversations like this because people either think I'm crazy, stupid, or right, and sometimes some combination of all three. So
I love that. That's the side of an iconoclast. So
yeah, 100%. Yeah, Tyler, you take this away. This is kind of your idea on, people know that you've been focused a lot on this hyper-financialization of the world. So yeah, I'm going to kind of kick it off to you to start throwing some questions at Hunter here.
So, I guess to start, I'm gonna hype you up a little bit, Hunter. But so when I was in college, I was a walk-on a basketball team at Boston College, which is an ACC school, and I just need to tell this story because I was a scrub. And in high school, you think you're pretty good at something, and then you get to the next level, and you're like, this guy just dunked on my head, and he was drafted, in the first round of the NBA draft, and I have no hope at playing basketball for the rest of my life. And my point to this is, when you find somebody that is just like head and shoulders better than you, and you like read their work, I say talent recognizes genius, but mediocrity knows nothing higher than itself. It's like I'm pretty good at realizing that after my basketball career. And so, I'm reading Hunter's stuff and I'm like, God damn it, this guy is better than me at everything. And I poor man's version of market structure. And so I was like, Hunter, we got to have you on. So that's my intro here. But I guess, where to start would be, why don't you talk about like the overall historical market structure and where you started? And then I can kind of like pick into that if that works.
Yeah, no, that's great. That's great. And to your point, which thank you. And I heard your shout out last time, and I can only say, man, the bar for genius has gotten dangerously low. But I think some of where I come from is I came out of undergrad sort of right into the alternative asset space without an investment banking background or sort of that traditional training. And certainly in some aspects it's been hindering, but in others I've had to figure out what's going on kind of without that bias of here's how things are supposed to work. Here's what a normal market looks like. I just had to sort of step into the river as it was that day. And so I think that has in time kind of been a huge benefit of just seeing what's happening. Rick Reeder has a great thing I heard on a podcast that he tells his traders. He goes, imagine you just woke up from a coma. You haven't picked up a newspaper, you haven't opened Bloomberg, and I just tell you that gold's at $4,000 an ounce, and oil's under $60. Well, you say, well, we have inflation and we're in a recession, and you sort of just have to take things as they are, and listen to what the market's telling you. And so, I come from like an academic economics background, and economists sort of present the world in this, what Minsky called like a village fair model. There's like the butcher, the baker, the candlestick maker. They all meet up and trade to maximize their utility. And they like ignore that finance exists at all. Like credit, borrowing, sort of in these, the finance is something that's happening sort of over top or next to the market, but it doesn't impact anything, kind of in classic models. But of course it does. People maximize their utility over much longer time periods. They borrow or invest and save, and they have lots of, interlocking and complicated credit relationships with each other. So that's sort of like where we find ourselves in, is this world with like a lot of finance. And I would say in a normal, or the way we think of this thing happening, sort of maintaining that village fair model, is you would have some value added idea, a business or some physical capital you wanted to build, a building or a factory or something, and you would raise equity for that. And that's a good market because there's a lot of people that want to invest, but there's a really like very few number of actually good ideas. And so people go out to raise equity, but there's not that many good ideas, but a lot of people, so it makes a very efficient market. And then once you have equity, you would go out and look for debt to grow. And then it flips, where there's, all of these good ideas and good projects, but there are very few capital providers to provide debt. And so these two markets, in theory, have a nice equilibrium. And I think where we've gotten to today is that there's almost no one really willing to provide equity, and a ton of people that are mandated to provide debt, basically to create debt paper. And that's very distortive to how economies grow and develop when you don't start with this kind of entrepreneurial, broadly speaking, spark that has to attract equity and then has to go out and find debt. You just have people like, basically calling you up, like, can I make you a loan?
So when you think about that ideology, right, we're essentially, because of the demographics, you're playing not to lose when everyone's trying to lend you money. If you think about the psychology of a debt investor, it's like, first I want to play not to lose. Like, I just want to make sure I get my money back, and I don't want to play to win. And therein lies like the baseline incentive. Is that accurate? Where we went from a frontiersman American attitude to almost, risk averse.
Well, this gets into, where the line between what is debt and equity. It's not like there's some bright red line you step over. It becomes very philosophical about what is debt and what is equity and how is risk split up. And, in a loan from a bank, a standard bank loan, a corporate level unsecured, that's pretty clear. What the security is. There's somewhat standard terms. When we move into this private credit space, it gets incredibly idiosyncratic. There's a great paper out, I'm hoping to write about it soon, where they're sort of talking that private credit's sort of bootstrapping alpha ex ante through all of the covenants and terms. When we think of valuing something like a debt instrument, we think of either, well, what does it look like on a spread comparison? Or what does it look like on a discounted cash flow comparison? And people certainly, you can open up Wall Street Journal, Financial Times every day and see that the spreads are too tight, or sort of all of these value judgments about how private credit looks different than what people feel like it should. But we really don't know, because they're sort of working all of these liquidity events into the contract terms. If there's a change of control, if a covenant's tripped. And so sort of the traditional ways of valuing it, to me, just probably are not applicable to private credit, especially once you zoom out and try to say, here's what a sector-wide spread is or something. These are incredibly idiosyncratic instruments. And I guess sort of getting back to your point, how much like equity and how much like debt are they is, I think, an open question. I think they are, in some senses, kind of backing into an equity-like return structure.
Gotcha. And so I guess like to zoom out, you had this one. By the way, your Substack's fantastic, and I wanted to read this snippet. You said, as Russell Napier points out, the world fell into a monetary and trade system imposed from abroad. When interest rates appeared to be permanently depressed relative to growth rates, asset valuations rise, leverage increases, investors are incentivized to pursue gain through rising asset prices rather than through investment in new productive capacity. The decoupling of growth and interest rates was driven by People's Bank of China appearance as a non-sensitive buyer of U.S. treasuries, and indirectly by the role of China's excessive fixed asset investment played in reducing global inflation and hence interest rates. In the U.S., the most successful companies have pursued high value-added services through business models that extract rents from intellectual property, moving actual production to progressively cheaper and cheaper geographies. In the blackboard of understanding free trade, the winners win more than the losers lose. That understanding is based on the belief that the availability of cheap goods is more than ample compensation for the loss of social mobility or security through traditional employment. For most economists, cheaper goods and higher consumptions are values in themselves. So sorry to go on that, but I figure that's like a great way to start, like,
I mean, you just defined financialization,
yeah.
Essentially, where there's basically a demand for debt. And this is really a Mike Green kind of riff, which is there's a demand for debt and the absence of productive uses for that debt. And in the case of the US in particular, all the things you mentioned, low interest rates, sort of the offset of inflation from cheap goods from abroad, have sort of muted the more acute symptoms of inequality. Yeah, we have massive inequality, but at the end of the day, there's a bit of a salve on it. Like, I have the same iPhone as the Kardashians. We watch the same Netflix. We can have some kind of comparable level of material comfort, even if financially, we're, people are way more precarious than they are from a financial standpoint. You can sort of keep the game going on sort of a baseline material comfort idea. That model of, well, we'll just do the nasty bits elsewhere. We'll just find somewhere else to make t-shirts. But then what happens, and I think this has happened to some degree in China, is that eventually they get the benefit of that through an ascendant middle class, and you have to find the next cheapest place to make it. And there's an assumption that there's always going to be some marginal cheaper place to do this stuff. And this model also leaves out always what happens to the place it just left. I mean, America right now is the place it just left. We used to do all of this. Now now 20 years on, it's all happening somewhere else. And it seems like we're maybe just now starting to run into the consequences of that trade. We'll have low interest rates that would normally cause a lot of inflation. We've dampened that with cheap goods from abroad. But now we're sort of facing the consequences of it, in a social way, if not an economic way yet.
And then, you lead into that, kind of hollows out your manufacturing capacity as the one that we're manufacturing left, right? And now we're in this place where our financial markets don't actually want to finance the industrial plant or whatever it is.
Yeah, the returns are lower. The returns are just lower. It's physical.
And people don't want to do it publicly either. That's something that you had an article in there just about this huge shift where you said this idea that equity markets have systematically failed to provide accessible capital to the broad swath of American enterprise, forcing a mass exodus towards private debt markets. Like, that is just a huge change.
Yeah, especially anything that would be, nobody wants to have a balance sheet. No one wants to have assets. You want to take you want to be a toll booth on some sort of IP, or like everyone wants to be as asset light as possible. So, financing anything that was capital intensive was just not going to work on public markets from a multiple standpoint. Private credit has happily stepped into that because they have sort of this asset capture model where, heads I win, tails you lose. You pay me back at S plus 700, great. I own your GPUs now, also great. Like, that's where I'd say, it's kind of like, is that debt? Sort of. I think it's kind of like asset capture financing. Not that they're making these to loan to own, but especially at the large scale, they're going to eat the economics of these capital intensive businesses way before equity does, which keeps the multiples low, which, kind of, again, like I said, degrades the public markets more and more. Tyler, to your point about manufacturing, there is like kind of this ascendant sort of fetishization of like bringing back the factories. And, and I think the people that are pushing that politically, their heart is in the right place for providing jobs in manufacturing and sort of restoring some economic activity, parts of the country that have been hollowed out. All good goals. Kind of zooming out from an academic perspective, that's not really why you want to have manufacturing. You want to have manufacturing because having lots of different industries bumping up against each other is how you actually have innovation. That,
Mhm.
you
Yeah.
know, the like that's where, Kevlar was not designed for bulletproof vest. It was designed for tires, but it works for this. And, you have all of these diverse industries that are pursuing something and they bump up against each other. And that's how you have actual innovation that actually leads to productivity gains, that actually creates economic growth.
That's a fascinating one because that mimics a lot of what's gone on in actual financial markets in terms of if you analyze the incentives. One of my MIT buddies told me this is like when you have a heterogeneous market with lots of different incentives and lots of different counterparties that buy and sell things for different reasons, it's actually really healthy. And you probably have more innovation that way. But when you have, these giant oligarch type multi-asset managers that all have the same incentives, which is like, risk adjusted returns that, just spew out 7% a year. And then everyone has the same incentive and they're interacting with each other. So you have these bouts of like systematic volatility that, until the government bails it out, it flees and then it goes back to normal. But, I've never thought.
So, okay, that's a great, and this will be, on brand for Blockworks. I think this is like what crypto is working through now, is trying to figure this exact problem out from a capital markets perspective. And we're thinking about this a lot. In traditional finance, to your point, you have all of these different pools of capital, and typically what differentiates them is duration. You have, hedge funds, pod shops, fast money, all the way up to asset liability matchers like life cos and retirement plans and people that are investing for a much longer duration. That is the part for like, digital assets that like hasn't quite been filled in yet. And so you have, finance is just a way of moving money through time.
Yes.
Borrowers need future dollars today.
Yeah.
Savers need their purchasing power plus a little more in the future. Finance links them. But in digital assets, like, the saver is like looking to Monday and the borrower is like looking to, Saturday. And it's just too fast. And so you have this rapid, that's why like in the, like the DeFi yields like spike and then collapse. And, there's just not that long duration capital to help balance things out.
That's a fantastic point.
Yeah.
I love that.
Quinn, you're a credit markets guy. Do you have any questions for Hunter in terms of that world?
One of the things that I think does not get discussed enough in today's environment, there's a number of factors, but it's this idea of the crowding out of the private sector and debt capital markets. And it's hard for people to see this in the data because everybody thinks that crowding out means, debt crisis and spreads blowing out, etc. So part of the reason so what we've seen is debt issuance, the proportion of total U.S. debt issuance from the sovereign, the government, is at record levels relative to corporate debt issuance in the public markets. And part of this does have to do with the debt issuers of how Fed conducted monetary policy when they hiked the front end and then the Treasury was keeping the back end suppressed. And so this uneven tightening of policy that hurt front end borrowers. But then obviously another big part of it is just the, exorbitant deficits we've been running that have forced massive issuance. And actually, in the data, spreads, like this, one of the reasons I wasn't too concerned with this recent backup in credit spreads is because you had this onslaught of issuance over the last few months, both in the high yield market as well as in the treasury market to refill the TGA, that needed to be digested, and you needed spreads to back up because at the same time yields were coming down, base rates were coming down from the lower growth, and so people needed to be compensated for all-in yields. Anyways, maybe fast forwarding to this crowding out effect, to me does not, as long as we believe that deficits will continue in some, unsustainable way, then the crowding out effect sort of will not go away. And eventually that should show up somewhere in terms of credit availability or access to capital. And so I'm wondering if you've done anything around this idea.
The way I've thought about it is definitely more from the private credit side, although the crowding out from public debt issuance is a factor where there is a lot of money that has a mandate to buy, and this is kind of like throughout the credit spectrum, they have a mandate to buy high yield. And so if some things that were becoming high yield are going to private credit, there's a lower supply of high yield. People that have a mandate to buy it have to buy it. It drives spreads lower. Private credit is pricing the private credit off the spreads that are lower because the supply of high yield is lower because private credit is doing the lending instead. And so it becomes this like reflexive loop of private credit limiting the supply of high yield debt issuance. People that have a mandate drive the spread lower. And then now private credit spreads come in because we will see.
Completely self-reflexive. Yeah.
Yeah. We will see what happens because I agree with you. When SOFR comes down, spreads will widen out. When they're doing the underwriting, the risk is the risk. It's a 9% risk. It's a 10% risk adjusted they're going for, or whatever. And so when SOFR comes down, spreads will go back out. At SOFR where we are now, it sort of makes sense to me kind of where things are. In terms of the public debt issuance, I do kind of come from a market structure standpoint and just like who has a mandate to buy what and how much supply of that is there to buy. I did not feel like as the Fed hiked, it didn't seem to me, at least perhaps on the high yield side, but on the investment grade side, corporate issuance didn't slow down at all. And I think it was really interesting that, again, in a textbook model, people believe there's going to be some linear relationship between interest rates going up and business activity slowing. And I think it's far more kind of bimodal than that, is that there is absolutely a level at which interest rates begin restricting business activity, but then everything below that level doesn't matter. Like the Fed was certainly not willing to go to whatever that level was required to actually impact that. So, if you look at investment grade issuance as rates went up, they didn't care,
Yeah. It has to do with the uneven adjustment of policy because their policy benefited the long-term the investment grades are borrowing 10 to 30, maybe sometimes more years out.
Yeah.
And the treasury policy of active issuance kept the long end down and hiking. And then you have the high yield average duration on HYG is like 3-4 years.
Yeah.
And a lot of these guys are floating rate, so they got screwed. And that's really the reason for the Main Street recession up until basically now that I think will come out of next year.
Something I wonder on that point is just been thinking a lot about what kind of signal can we derive from publicly available credit spreads in this day and age because of two reasons, just the proliferation of movement into the private credit space and something that a lot of people don't talk about is back in 2020 when the Fed actually started to buy corporate debt. And what does that do to the signal of credit spreads, right? Like, how do you price a probability of default if the Fed is buying corporate debt?
It also, can you go into, you talked about one of your pieces, how like the whole WeWork thing and how essentially it disrupted capital markets in a way.
Yeah, those three. See where it takes you.
Yeah, I mean, whether it's public debt issuance or public equity issuance or just, being public at all, it's a two-sided market. There's users of capital and then there's investors. And so these users of capital are making a decision and people might say, well, it's crazy, it's crazy to borrow from Apollo. It's like, the frog and the scorpion type dynamic, but they're making this decision for a reason. And I think the reason they're making it is because public market structure has just become very unattractive on a variety of fronts. Maybe on the public debt side, it's still pretty attractive again, because on the passive and mandate side, like you can come come to market with an issuance and know you'll have buyers. That is not true on the equity side. You've got these multi-manager and market makers that are controlling, $1 trillion a day of equity volume. When you factor in leverage, they're not taking a small float. Like, no, there's no one there to buy a small float company that's predominantly owned by a private equity firm. That's just not something they're ever going to buy. So who's there to buy it? That chart I had posted of IPOs, I noticed was pre-Figma. So we've kind of caught back up, but again, it's one company. It's one issuance that sort of got us there. Yeah, I think spreads are really hard to read in this market as being a high signal, like they once were. And something I kind of learned on the private capital side when I was getting pitched funds, there is a lot of money kind of earmarked out there to step in when spreads go above 650. I got pitched on multiple funds that were, hey, you're going to make a 2-year capital commitment, and if spreads are above 650 for 30 days, we're going to call it.
No way.
Wow. Yeah. And so
that's fascinating, because is that boomer driven, or life insurance companies that just like need the yield, or pensions, I guess?
Well, I mean, I just ran the numbers on this. When high yield spreads are more than 2 standard deviations above their average, it takes them 6 months on average to come back down, and that's like close to the median as well. And you can look at the high yield spread chart and see it's this spike, and then it kind of collapses back down. And I do think it's just because there is a lot of capital sitting and waiting for those spikes.
Interesting. So it's this self-reflexive thing where it's like Fed policy wants to, as soon as you see the spikes, Fed policy comes in, dilutes the currency base, or does some sort of.
Well, I do think, I mean, the lesson that they have learned is the way you prevent contagion is stabilize spreads, and that's why that is the playbook now.
Now, what you're saying is, and this is what I think all these quant and systematic investors program their stuff on, is the price is actually wrong. Like, if you look, the public market price of spreads is actually wrong. And Mike Green actually just put out something on this, which says if you actually they should be 300 basis points higher than they are. But, because of the constant reinvestment of these products, it actually completely has distorted the price.
Yeah.
And so these self-reflexive, can you talk about, and just, we have another, couple minutes, but can you talk about the effect of passive? And you've talked about the compression of fees and essentially what that's done to capital markets as well, because now we have these completely imbalanced capital markets. And I think the system, you've annihilated a lot of jobs, and it's kind of like a factory, right? Where you're spewing out slop in terms of the companies that come out of this stuff. I mean, you see a $10 billion company with no revenue on the equity side that gets capital, but no one wants to finance the good growing 20% mom and pop business. Can you talk?
Yeah. I mean, part of it is passive, and part of it is the growth of private markets. If you're a really profitable or really fast growing startup technology company, you're raising your Series G or F, it's insane. So public markets do not have access to that. And if you're a really profitable, well-run private company, you're in a PE portfolio. And so the quality of everything, mid-cap and below has just continued to basically degrade. In terms of the market structure, I spent most of my career in listed real estate, REITs, which is a tiny, tiny sector. It's 1.3 trillion of market cap. We're talking about an entire sector of the S&P that's a third of the size of Apple. You think about large pools of capital. One of my employers had 90 billion of assets under management, 30 billion in listed real estate in a 1.3 trillion dollar. So already half the names in the index are unbuyable. And so you do some work and some company comes out with an earnings announcement. It's similar to the IPO. Who's there to buy it? Who's there to set the price on that? Who's the long only real estate manager, and pick any sector that's like this, that who's there to do that price setting? It's funny because this is some of the original, if you go back to when Bogle launched the index funds, This was like some of the original pushback was that
Yeah,
you're a free rider, you
yeah,
know, like
totally.
there's supposed to be price setting.
And then, like, so what's the end game? I mean, to me, if you zoom out, my simpleton brain is saying literally all these things. And I think you even said, or is it, corporations are increasingly driven by shareholder primacy, redirected investment from domestic production towards global supply chains, financial engineering. This architecture generated substantial aggregate wealth, but distributed it with growing inequality. The availability of ever cheaper imported goods alongside the distribution of high-speed broadband, mobile telephony, I don't know how you say that word, offset middle-class wage stagnation. These forces, once celebrated as the engines of prosperity, now reveal themselves as architects of the very instability they were meant to prevent. So my simpleton brain is like, this is just, it's like a crap, it's like it's unstoppable force meets an immovable object. And this is the social contract just getting destroyed, because all of the things that we've created from a regulatory perspective seems like just incentives to make bigger, more scalable things that are like at capital light, and labor just gets annihilated in that world.
Well,
Is that, I don't know.
yeah, and I think especially people who've been aware of markets or in the industry for the last, let's say, 25 years have gotten conditioned to think that there's a Minsky moment, a breaking point, the damn breaking moment. And I just don't believe that's going to happen. I think the reality is actually much bleaker, where things just get slowly worse and worse. And that's kind of like a ceteris paribus, like returns degrade. We have a decade of flat equity prices. Multiples come in, but it's death by 1,000 cuts, and it's volatile. From a market perspective. From like a societal and political perspective, I think it's an exciting time because you're starting to see the arrow only moves one direction. You're starting to see how people are responding and evolving. We have the tariffs are back. Like, there's you start to see how the system is like trying to figure out how to self-heal. And yeah, some of them are like ham-fisted or they're not quite the right way to do it. And I wrote about this as well. Like when, it was funny. So I'll wrap up with this story of like the Liberation Day, the board coming out, and I'm on the floor that day and the market's up that day. I forget what day that was. So the market kind of like was trickling up that day. And so we were all like, this is a really leaky administration. I'm sure word's getting out that they're not that bad. It's going to be kind of, and then the board comes out.
Exactly.
It's like, now, Liberation Day seems like it was a decade ago and but I do think that moment was like kind of a bell that can't be unrung in terms of market structure and economics, just kind of the way, like, even if the next day or the next week, which basically happened, he like rolled it all back, everyone has internalized, just like with COVID and a pandemic, this is a thing that can happen. This is this is something that could actually happen, and people start rearranging their supply chains and people start thinking about how to allocate capital differently. And so I think you're right. All of these things are coming to a head, but I think the opportunities from an investor standpoint are to see how we're evolving, how society and politics and economics is responding to that, and finding the opportunities in there. You certainly see, like on the venture side, like overnight, all venture capital wants to do is defense tech. Like,
yeah, it's so true. Yeah.
So like there's these things that happen, and you can't get a SaaS company funded, but you can get autonomous drones funded, no problem. So
in that world, like, so this is my, going back to my stupid macro, is you need nominal growth to grow out of all this debt. So the government is literally just it's going to be like public-private partnership city, where the government just needs this industry to grow. It's almost like we're flipping with China in some ways, where it's like
100%.
China needed a lot of these industries. And I don't know if that's going to be true or not, but it's my general thesis is like, they have to create nominal growth somewhere and grow out of the debt one way or another. And that's why I call it like Weimar America. Is like, we're just going to keep printing money and doing this MMT stuff secretly to grow out of it. Is that,
which,
I don't know.
yeah, which like, could work if it's thoughtful and done well to some degree. Like I think of the CHIPS Act, and it was like, there's a critical industry. I'm like, yes. Like, it's crazy to have all of this in Taiwan. Yes. We're going to build in America. Yes. And we're going to do it in Arizona. And you're like, like, like it was so close to like being like directionally correct, in terms of industrial policy or how the government could interact with markets in a way that was really positive. And then they just couldn't help themselves. And they took it like one step too far to kind of make it unworkable.
Yeah. Why was it not going to be I'm just curious on the last question on why is Arizona such a bad place? Is it just water wise?
Just like resource wise, like upstate New York is like a great place to do that. But, I'm sure the sausage making of politics, like, just didn't fall in that direction, and it ended up being in Arizona where like now the transportation cost for everything you need from Canada to build these. And, it just like goes on and on of like,
Gotcha.
Yeah. Whole
Makes
bunch of
sense.
lobbying and all that.
yeah, like overly prescriptive, but like it is encouraging to me. I think there's this idea, and like libertarians hate this, and I don't really have a value judgment on it, but like the government is part of markets. They are part of the economy. And I think this is, at least, to give MMTers some credit, even if you discount like all of their theories, that is the one thing they recognize, is that the government is an economic actor. And this sort of this like Reagan-esque view that the government should just stay out of it, like that's not an option. Staying out of it is a choice. And we've tried that model where the government's like, nope, we're doing deregulation and free markets, and we're going to see how the chips falls. Like, we tried it, and here we are. Like, this is why, I'm reminded of the scene in No Country for Old Men when Anton Chigurh said, if the rule you followed brought you to this, what good was the rule? And,
Yeah.
that's kind of how I feel about this, like, environment we're in. And again, like, I can disagree with like the implementation or even how the tariff rates were calculated or whatever industrial policy comes out. But I do think it's at least directionally correct in a realization that politics, the government, society is playing a role in this, and we need to be thoughtful about it, that markets are not just going to like sort it out.
That's such a good point. Like that, the way you frame that is so, I've never heard it. And it's so true, because economic theory lives in a vacuum, but reality doesn't. So we might have the freest capital market in the world. And if you're, it's just like monetary policy. If the rest of the world is stimulating and debasing currency, we can't just let the dollar go to the Dixie, go to 200 and ruin all
right.
And the same way goes with China. It's like we have the freest capital markets in the world. And then look what happened. Solar panels, electric vehicles, everything gets dumped. And then your internal industry's screwed. Your jobs go overseas. And then it's like, no, wait, actually, this is almost becoming national security because, our middle class is hollowed out. All our innovation, you need to import your population growth. Then you lose your actual cultural identity to begin with. Like, it is so true. We're at like a tipping point, and you have to action something to protect.
Yeah. And I live in New York, where we're about to most likely elect, Mamdani governor or mayor, excuse me.
When are you moving to Texas?
But it's like, why is that happening? It's because people don't feel ownership in the system. They feel like this is not, and the way you fix that is to, you don't make capitalists by like preaching to them. You make capitalists by giving them capital and like,
and empowering them.
Empowering them
exactly.
to be a participant in the system.
All right. I think we're going to wrap up there, but Hunter, that was truly awesome. Thank you so much for joining us. We'll put your Substack in the show notes, but where can folks go if they just want to hear more of your work? Because I was reading some of your stuff. It was awesome.
Thank you. Yeah. So lewisenterprises.blog is the Substack. And then I'm also going to make a plug for American Affairs, who I've written for, which I think is a really valuable publication that talks about a lot of these issues in a really thoughtful, nonpartisan way that I think everyone should support. So some of my writing's in there, but I think if you're interested in this line of thinking, that's where I would direct people, whether it's written by me or not.
Awesome. Thanks so much, man.
Cool.
Thanks, guys.
Yeah, thanks, Hunter. All
See you,
right,
Hunter.
take care.
See ya.
We're kind of like a news organization now. Hey, you just pull somebody in and we just cut them off and we keep recording. And now we're here in the roundup chopping it up.
Yeah, that was fantastic. I love that stuff just because, like, I don't know, that markets and incentives, like when you break it down on the baseline, you can really tell what the future is going to be. And there should be way more work done on this stuff rather than, academic papers like this. We've built trillion-dollar industries on the back of this stuff that just is killing us as a country.
It's funny because economics and like the professor and textbook educational theory world has like lost so much credibility over the last number of years because they've gotten so much wrong and steered so many things in the wrong direction that it's damaged. Like, those are normally good things to have and you need them, but because they're so, one, politically biased, two, looking backwards, not forwards, and evaluating the wrong problems and coming to like the wrong conclusions, those two combined make it so like it's lost so much credibility to educational and research institutions.
They used
when
to
you
be
still need that.
Yeah.
Also, like media in general, man. Like somebody like Hunter, like this is the new media. Like if you go compare how smart that guy was versus what you hear on CNBC every day, it's just insane.
Yeah. I think that therein lies the issue is like to be a true iconoclast, there's so many incentives, and I'm just going to pump Blockworks tires and I don't even get paid by them. But like you to have someone who is an iconoclast and talk to them, it is so hard nowadays because the scale of those institutions that own everything where they advertise, like we can say whatever the hell we want on here and no one gives a shit. Excuse my French. But like when you get onto those mainstream networks, if you say one thing that's like anti BlackRock or whatever, you don't go on there anymore. But like he can, Hunter's written about how passive it's just like evolved from this fiduciary rule, and then Morningstar basically like created all these ratings, and then you got a better rating if you lowered your fees, and it's all these incentives that unraveled into trillions of dollars of industry and perverted capital allocation. And so, the hard part is actually the reason why experts and mainstream are so wrong is because they're co-opted, and you actually have to be smaller to be unco-opted is what I'm trying to say. And I think it's so rare to actually have that.
Yeah, because economies of scale exist in every industry, and it's hard to survive the smaller you are. Like,
I mean, that's what I've had my problems in my careers. I've been handcuffed by compliance that you can't talk publicly. If you say things that are true in these giant organizations, you're looked at as like a complete kook because it's like
you're getting the tap on the shoulder.
Yeah, and so you can't actually do that at any like institutional place. And the one place I can do that is Muddy Waters because they actually are trying to find the bad guys. It's just like, but like, vice versa. Like Felix, you're at Blockworks. Quinn, you're at your own shop. Is like you actually can say things. Like, you can be wrong. I could be wrong, but like at least
we're wrong all the time. Why don't we throw some stuff at the wall here and see how much we get right, how much we get wrong?
Yeah. Quinn, hit me with some slides.
Quinn, walk us through some slides here. What do you want to talk about?
The little Quant Corner
stuff. Yeah.
Start me on 21. Generally speaking, I think it's been an interesting few months where you obviously had a huge recovery off of Liberation Day lows, and a lot of that fed into sort of this low vol summer exuberance, memes, retail, everything popping off. And then, fast forward, we're 23 days into Q4 in October, and trying to suss out what's gonna kind of play out the rest of the year into Jan. And you had this period from August, September through now of refilling the TGA, which was this drawdown of the TGA due to the debt ceiling was part of this liquidity stimulus early summer out of Liberation Day lows. And there's actually been, I don't think we appreciate the level of like fear and anxiety in the markets because, S&P is sitting at all-time highs. And so when you put that together with some of these stats I want to run through, it almost doesn't make sense. And it's the situations, I think there's so much about the macro environment today that doesn't make sense, but they really require first principles kind of thought. And so, this chart here is global equities net selling or buying. And it was, I can't remember the date of this. I think this was actually last week. This was, I think, from last Friday, was the largest 1 week selling period since Liberation Day. And that goes back for a year. So it was the second largest 1 week selling. On the next page, you can see we were pretty bought on equities and positioning, but that got rinsed pretty good, consolidated basis. CTAs were long. It's nothing near on the next slide, Liberation Day levels, but that's a very rare occurrence. And then on the next one, you can see the sort of discretionary versus systematic equity positioning. You have the discretionary in the green line, which is de-risked significantly. And systematics have come down as well. Next slide, you have basically option skew for treasuries, meaning higher, that line going up is showing higher call demand for treasuries, meaning, risk off, buying bonds, betting that bonds, you want call options on their price, yields down. That's a growth scare recessionary data point. The next slide, you have near record outflows in a week span on KRE, which is the regional bank index on all of these fears, despite, most banks reporting phenomenal earnings. The next slide, you have two charts that show, obviously we all know the gold story, but I want to quantify that a bit later as well. You have biggest ever gold inflows, and you had, the largest high yield bond outflows since Liberation. So what I'm trying to paint here is like, despite the S&P being at all-time highs, we've just experienced basically 2 to 4 weeks of the price action you would attribute to like maximum fear and recession and just anxiety, scared. The fear and greed index is at 25, which is, that never leads declines. That's a number you buy almost every time and you make money 1 to 3 months out. And I don't also think people appreciate some of the VIX levels. This was actually on a relative basis from Delta adjusted. The VIX spike in the last 2 weeks was the fourth largest in the last 3 years. Think of that. Dating back to mid 2022, the fourth largest VIX spike on a relative Delta adjusted basis in the last 3 years. You have Liberation Day in there. You have yen. The two others were Liberation, yen, and March regional bank crisis. This was like a huge, and it just kind of doesn't make sense, because like, you're like, what are you talking about? Stocks are at all-time highs. And this goes to the stuff Tyler talks about with the centralization. Like, you're seeing these crazy factor reversals where, Mag 7's up 1 and the S&P's flat because, everything's else down 1. You have the opposite. And while everyone's staring at the gold stuff, my point is, don't lose sight of what a, frenetic bid into gold really means. That is, protection against inflation, protection against monetary and fiat debasement, protection against a bad economic event. It can be any or combo of all those three. So the next chart, these gold numbers are mind blowing. So the next chart is the spot ETF gold AUM. Like, this is incredible. And clearly, like, that it's just been retail piling on, the lines at the physical stores. But, from 2023 to now, in 2 years, this thing is like 3x assets. Like, so say something.
I was just going to say, like, so, to hold ourselves accountable, on our performance and Blockworks calling these, I did get a little freaked out on this VIX spike in credit. Like, I saw KRE rolling over, all the private equity guys rolling over, gold going parabolic. And I'm like, there's something funky here. I've never, like, this doesn't make sense. And now, and we see it, 2 days later, 3 days later, it's like credit's firmed up. where market's close to all-time highs again. And I'm like, wow, luckily jumped back in, but like,
I was very perplexed too. And I think we figured out, we're kind of talking a little about this earlier today before the show, but I think it has a lot to do with the combination of the government shutdown and just where we're at in terms of liquidity dynamics in the funding markets right now. Cool. We'll come back to the rest of your slides in a second and talk about the crypto side of things, but I'm just going to pull up a couple of the funding market stuff. So this has been a really confusing one because, people have been trying to figure out what it means. So standing repo facility uptake, basically what's been going on is, okay, we've talked about how quantitative tightening has been happening. And then you have the reverse repo facility has been masking a lot of that bank reserve constraints levels. That's fully depleted now. Then we had the TGA rebuild once the debt ceiling was ended. That got us up back to $850 billion. And then now you have no more RRP. That's at zero. And then you have outsized bill auctions happening. And then you have the government shutdown in earliest happening now. So what's going on there is, okay, they keep having bill auctions. So they keep going to vacuum up dollars from the system and then exchange for bills. But then they're not spending any of the money from the TGA right now. So what's going on there is that where is this liquidity going to right now? Is it's going into the TGA. So they want to have the TGA at $850 billion as like the absolute highest level. Because of the government shutdown right now, you can see this is at $930 billion now. So it keeps ticking up because they're just not going to cancel treasury auctions. That is just not a smart move for treasury to do. So they're still doing bill auctions, but there's nowhere to spend the money because the government is shut down. And then you have this kind of, commercial bank hiccup that, the KRE index that you guys are both just talking about at the same time. So then you have a little bit of uptake on the standing repo facility. So it's like this weird constellation of funding market weirdness that I think led to collateral levels to blow up a little bit, volatility to get blown out. And then you just have this whole unwind that Quinn just talked about. It was I've started to figure out, I think, I don't know, poke some holes in that, guys.
The most obvious hole in that is we've abstracted think about all the things you just said and why, like, it doesn't have anything to do with earnings.
No, I know.
Everyone's talking about
it's just flows and market structure. Yeah.
And like, therein lies, it is super important to learn that, because I think what happens is the counterparties, like we were saying, is like, there's such big asset managers now and they have different strategies and everything, but they cause such crazy imbalances for short periods of time. And the self-reflexive thing is the government's just going to bail them out because they're so big and systemic that, like, you turned into like Weimar America. They don't bail out the retail investors in the high vol sectors, but they'll bail out the big guys. I don't know. That's my initial thoughts on that, is like, as soon as the funding markets turn off, there's just self-reflexive, like you could see Fed funds futures basically pricing in, there's 100% chance of a cut. And then there's more, by March, there's 3. So,
well, that's why I struggle to see the bear. I mean, there's a million reasons to be bearish all the time, but prolonged liquidity problems is not one of them. Heading in, just given what we know about the current Fed's appetite as well as the futures, and the last, maybe Felix, last few slides, maybe go the 29, just to wrap this section up, because I do have a couple things on earnings. So this is percentage of ETF notional volumes, which you can see is a ludicrous spike, similar to in actually later, mid to late 2020. And then the next one is gold total option OI, which this one is also just insane. Oh my God. You had like a 5x year to date in gold option open interest.
And then you have everybody lined up in person. You have everybody was like, you see those lineup videos, everybody trying to buy gold. It's like,
this spooked me. And we even have a precious metal strategy that's crushing it.
So one of the things that I want to, a point I made in a letter I wrote this week, was that everyone always argues who's right, the bond market or the equity market. And actually gold has been the best, the most accurate, in my opinion. No one talks about this, but it says different things at different times. But when the really weird thing is having stocks at all-time highs and rallying in the same time as this gold move as well, which is saying that markets believe that real rates are and will be suppressed to maintain liquidity to get through the economic problems that gold is showing. And the next, I'll go quick. The next slide is just this shout out to Walter Rebello. He's from Brazil. I tweeted if someone wants to put this analysis together around forward returns after the size of a liquidation event we saw on October 10th in the crypto markets, and your forward hit rate on a 30, 60, 90-day basis is like almost like auto buy levels. And then particularly when you compare that to the average forward return, which is just like 30+% in 120 days. So this is across all markets. You had this like vol blowout that is in no, I guess my point here for crypto listeners is like, that was not idiosyncratic to crypto. This was a pretty dramatic vol event across all markets. It's just that the bid and liquidity is so incessant in stocks that they've recovered quicker. And
it came to
hold on.
Go ahead, Tyler.
I was just saying, let me play devil's advocate of that. On the index basis, yes, but like if you look at the momentum sectors of the market, where all like this is, I did warn this, is like when you look at the quantum computing stocks and the AI infrastructure stocks, the implied vol was in the 99th percentile to the realized vol in those sectors. And that's where retail was just levering up and YOLOing call options. And those are not, got crushed, but the index is at highs. Because the buybacks.
Buybacks have been blacked out for 6 weeks. Buybacks come back next week. So this is in a market with no share buybacks at the corporate level because they're all blacked out at earnings, which is insane. So this is more of the story. This is going into the next slide. I just show this chart that shows how fiscal and financial conditions easing into next year ramp up. This is, has to do with OBBA, Fed easing. So you very likely to get a positive growth impulse into the first half of next year. And then that's on top. That Fed easing, that fiscal easing is on top of, the next slide is you have 85% of the S&P 500 firms that have reported earnings surpassing profit estimates. They're blowing them out of the water. And that's on the last slide I show. That's with earnings revisions prior going in being very elevated. So they're blowing out of the water, revised upward earnings. And then the last slide just shows this period through the end of October, how you have these elevated implied daily volatility moves that drop off a cliff going into November. So next week you have FOMC, you have QRA, you have the ISM, you have the Trump-Xi meeting, and tomorrow you obviously have CPI. And so you have this like heightened anxiety from all these things we just worked through. I personally don't think there's a big credit crisis brewing, and you have this huge slate of events next week that everyone's hedged to the gills for. I think it feeds perfectly into the Santa rally. So that I thought these were really interesting because as I was going through this data, it was so interesting to me, but it really helped me quantify and understand why the anxiety level is so high across all market participants right now.
I think you nailed it, and I'm in the same boat. What's interesting is everyone before this little gut check sell-off, everyone was already positioning for the Santa rally at low vol.
I was going to say, I wanted to do a little reconciliation of where we were before we went off the DATS and we were off. We were calling for that up only melt up rally, and then we got smacked in the face, Mike Tyson style for a minute there by the leverage 100%. Flush. But to me, it's just like, okay, when I look at the fundamentals that Quinn just went through and what's happening in 2026, it's like, all right, QT is ending. They're going to be moving towards an expansionary balance sheet in like early next year. Not quantitative easing. I'm not saying that it's different. I don't need to get into it. More rate cuts. You have the OBB kicking off in tandem in 2026. You have potential reversals of tariffs depending on how the Supreme Court plans out. Or if not, there's still all these talks about what they want to do with the tariff revenue, right? Like, do we give out stimmy-checks or whatever? So you have all that happening. We got punched in the face by a leverage washout. But to me, that's like that's a time to double down, because the story is so clear to me for 2026. It's just like we said in the show, you just gotta get there in one place. You gotta size accordingly and not get over levered so you blow out during those punch in the face moments.
The maybe other thing to talk about is just the 4-year cycle thing in crypto world. That is just like, I haven't seen a bear case for crypto that's not either directly just blatant 4-year cycle, it's over, or a derivative, sort of a derivative of it that is basically just derived from sentiment around that. Like, so it's just so fascinating to me how that it's just like blatantly accepted, and it's just not a first principles argument, because the comparison is December 2021. You can't even compare 2018, because I mean, they were talking crypto is a tiny asset class, and then 2021 it ended because the Fed hiked 500 bips in like 8 or 9 months, and inflation, we had a war, inflation was out of, like, we're going into a looser monetary regime. It's hard to wrap your head around, but that's what gold just said. No one can wrap their head around gold move, but the sooner you do, the sooner you understand where we're headed, is my opinion. Maybe I'm fucking completely wrong and I'll look like an idiot. That could be too. I've been there before, but I'm just trying to arrive first principles. I can't just sit here and say 4-year cycle, I'm done.
Right,
I think what happened with gold is, I think first off, the 2-year yield and Bitcoin are the two most important assets to watch globally. I think that's what I figured out, is like, I think Bitcoin leads a lot of the plumbing problems and also a lot of the geopolitical problems. When you think about like its ownership is global, you have a real-time price. Like I think it was discounting was a lot of this China trade stuff, where a lot of, let's simplify it. I think gold was China buying and basically giving a shot across the bow to Trump and saying, hey, we're going to dump your treasuries and we're going to use this new collateral for our yuan backed gold, gold currency. And then, we're also going to smash your Bitcoin because we have a lot of miners or whatever supply in China. This is obviously a little bit conspiracy theory, but like, regardless, these are two big behemoths trying to battle for what the next 21st century reserve collateral is. And we're seeing these forces go back and forth. And, in a lot of senses, I do think crypto is going to probably take off here into year end as these liquidity, the US unleashes liquidity, but you need the two behemoths to come to some sort of agreement before I think it does. Because there's
that looks likely for the end of the month. Like, they're going to have the summit. Xi Jinping and Trump are meeting, and that's a bit. I think that like 2 weeks ago we're talking about right after the crypto washout in October 10th. It's like, yes, time to slowly buy, but that was triggered by this aggression between Trump and Xi Jinping. But you know that the summit is not till the end of the month, so you have this moment in between where they can both escalate to increase their power or their bargaining constraints going into the meeting, and then they can de-escalate from there. So that they have nothing to lose by escalating further until the summit. And now we're almost at the summit.
That is exactly. So that's my point, was just like Bitcoin was sniffing out a lot of those issues, and so was gold at the same time. It's like those bargaining chips. This is way bigger than we think it is, this period of time. And we're probably going to look back and it's going to set the ground, the rules for the next, like after World War II, we had a bunch of like rules for the global economy. We're in the midst of this renegotiation of global social contract. It's kind of wild.
Yeah, it is super weird times.
Can we talk about one last chart? I just love this thing. This is slide 37. It's my only chart for the day. I had to put this in. There's this from our friend Robert in Frenomics.
We gotta get him on too.
Yeah, we definitely got to get him on. I would hassle him, but this nails everything to me just from a macro basis. Social Security and Medicare outlines as a percentage of U.S. GDP. Homeowners equity as a percentage of US GDP, and then your average per capita wage as a percentage of GDP. It's like, this is such a boomer. He called it the boomer retirement complex. And it's like, you know, it really nails where we are. And you almost have to say that one of two things has to happen here. The average wage has to go up, right? Like, if it doesn't, you're going to be in a complete, I don't know, pitchfork scenario. Like, I would be scared to be a politician if this goes even lower. And 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 the other thing is, I think you have, like, I guess homeowner inequity and Social Security could still go up from here, but that's got to come down a little bit relative on a percentage GDP basis. But like, this is why everyone in the next generations are just like, fuck this, this boomer stuff. And
you need wage inflation and asset returns to be real basis zero, and wage inflation is the reason. Yeah,
and then they're shocked that you got like Mamdani going to be the mayor, and like, this is only going to, if you don't change the incentives and the baseline.
This is the Mamdani selling point chart right here. Like,
yes,
if you're confused, look at this chart. Yeah.
So this, I had some conversations about this with some people in London at DAS, and my take, and Michael Howell actually agreed. That was so, Tyler, you would have loved chatting with him around, like, he's just an awesome dude too.
But he's got some stories. If you get a beer with him, he's probably like,
yeah, he does have good stories. But so one of the things that I was saying is, like, the whole world laughs at Trump and points at the US and points at Trump. And the irony, especially Europe, obviously, because like his abrasiveness is so unlike, French and German and, the Western European kind of culture. But the irony is that, like, Trump is tame and, easy relative to what the ultimate, end correction to populist movements can and often does look like. And
I agree with that, even though he's crazy. But
of course, but there can be worse than Trump in the US. But my point, kind of relative to Europe, is like, at some point these things have to fix themselves, like that chart you just showed. And just like anything, the longer you don't fix it, the worse it gets, and the harder it gets to fix, and the more destructive it is when you fix it. And so the irony of pointing and laughing at Trump is that, like, there's a much worse outcome than him. And I'm not even saying he's fixing these things necessarily. Like, so it's not a for or against or a political statement. It's just saying that, like, these things need to correct, and they will correct one way or the other. And the sooner you correct it, the better. And the irony is that, like, it's, oh, he's the crazy man, whatever. But, like, yeah, let your problems go another. I'm not saying Trump's fixing our problem, so it very well could get worse here. But, anywhere, let your problems go another 10 years, including the US, and we'll see what happens then. And it's not pretty. So, like, it's kind of like what Hunter was, like, that conversation with Hunter, where it's like, free markets and capitalism only work to a point until you become this extremity of inequality, and you have to step in to fix fairness and median outcomes. You can't let 99% of the wealth go to 1% of people without pitchforks. That's just like, doesn't work.
Yeah, it's one of the big lessons of history. Like, time and time again. Yeah. All right, that was a fun episode. It's cool to do both. The interview, talk ideologically, philosophically, and then get into some charts and stuff. So, yeah. Thanks, guys.
Good stuff.
Good stuff, gents.
Have a good week.
See ya.
You too. Take care.